All right, today we're doing earnings straddles, how they can be profitable, not financial advice, etc., etc. Here is a chart. Okay, let's call this Tesla. Could be any chart on the planet. Okay, and what we're going to do is talk about a straddle. So a straddle is when you take basically both sides of the move. So what you're doing there is you're longing volatility. Okay, so let's say that Tesla is currently at $150 or thereabout, and we're going to buy a call and we're going to buy a put at that strike price, right? Doesn't make any sense, right? Why would you buy a call and a put? Well, let me show you. Okay, up here will be 200 bucks, and down here we'll call it, let's call it $0. I don't know. Okay, basically this is going to be your P&L, and your profit is going to look like this. Okay. So because you're taking both a call right up here and a put right here, basically you're longing volatility. So you're playing or expecting that the volatility of the option is going to be more than what the market is implying based on the price of the option. Okay. So the market's going to imply a certain amount of volatility for Tesla, right? More so than other stocks because it's a pretty volatile stock. So what you'll want to do if you think that there's actually going to be more volatility, and a very common strategy for this is around earnings, right? Typically, you can generate a pretty high yield trade, a pretty high expected value by forecasting higher volatility moves, basically the size of the move, by forecasting a higher volatility than the implied volatility that the options market has on it. Okay. So as price stays around 150, which is where you take the call and the put, you make basically $0 because neither your call nor your put is worth very much money at all, right? You just get theta decayed, theta burned. But as price, like let's say it's a really big move, and this is why it's common as a prevalent strategy around earnings, and you can actually do it very profitably, is let's say there's earnings, which on Tesla there is in 4 days now, and the robo taxi, right? So here's a bullish thesis, robo taxi. Boom, the robo taxi news makes it go to 200 bucks. Well, your call is huge in the money. All you lose on the put side is the premium that you pay for the option, which is going to be spendy because you're buying an at the money option, but you're probably going to spend 400 or 500 bucks on that to make a couple thousand on this move right here. Or let's say the opposite is true, right? Let's say the earnings call comes out and Elon says, hey, we are going bankrupt. Tesla is going to zero. We're losing it all. Okay. Well, as price approaches zero, now your put is in the money huge, and your call, all you paid for that is basically the at the money premium. Okay, so this is a strategy that you can do around earnings. Another point here that I want to make is that you should isolate it around earnings. So, like, let's say here's another chart, and we have the 16th, the 17th, the 18th, the 19th, right? Let's say that earnings is on the 19th. Okay. And in the meantime, price is doing some of this, and it's doing this, and it's doing this, and this, and this, right? If earnings is on the 19th, I'm not going to start this strategy here, okay? Because I'm going to have to pay too much in intrinsic value based on how the option is priced for it to be even worth it once the 19th rolls around. You want to isolate the move, right? So if this is the start of day on the 19th, and let's say here's the close on the 19th, right when they're about to report, what I want to do is I want to take this strategy basically like right here. I want to try and isolate the earnings call as much as possible. And when the next day opens, the 20th, it's either going to move one of two ways, this way or that way. And again, so points here to remember. One, this strategy is common and can yield a very high RR when you think that price is going to be more volatile than what the market implies. So the size of the move is bigger than what the IV is, the implied volatility, okay? And two, you want to isolate as close to earnings as possible. And hopefully this strategy can provide you some value and hopefully some gains. Good luck.